The cost of living continues to cool in Canada. Canada's overall inflation rate in March was 4.3% year over year. That's down from 5.2% in February and a substantial drop from its peak of 8.1% in June of last year. This deceleration is largely due to a drop in energy prices. While the cost of groceries continues to outpace overall inflation, it's also slowing. Groceries clocked in at 9.7%, marking the first time in 8 months that food inflation was under 10%. Lower prices for fresh fruit and vegetables drove that drop. But while food and energy prices dropped, the cost of carrying a mortgage is soaring. Mortgage interest rates rose by 26.4%. That's the largest yearly increase on record, and it's being driven by Canadians initiating or renewing mortgages at higher interest rates. Francis Donald is Chief Economist and Strategist at Manulife Investment Management. All right, Francis, let's start with the headline number. Overall inflation decelerated to 4.3% in March. Your take on that number?
Well, it's part of the trend we know is going to continue. Inflation in Canada peaked in year-over-year terms last year, back in June. Now we're in the waiting game to see not just where it is this month, but are we going to get back to 2%? And there's some clues that, yes, we are heading back towards more normal inflation, like the numbers we've been used to for the last decade. But there's still some concerns that maybe there are elements of this story that are stickier. And even if inflation slows towards 2%, still growing. It's just not growing at the same pace as it was before.
Right. But as you point out, the first step is to try to get it somewhere back to normal. And last week, the Bank of Canada, it projected overall inflation would hit about 3% by the summer, 2.5% by the end of this year, and then get down to that 2% target really by the end of next year. From your perspective, are we on pace to hit those projections?
Yes, we are. That seems about right. But I'll emphasize here, there's a lot of things happening around this inflation number that make everyday Canadians feel like, who cares if it's 3% or 2%? We still have sky high food price inflation. That's an ongoing issue. Most of us still feel as though the cost of living in the past several years, forget year over year, is still completely out of line with wage growth, even though we hear policymakers say wages are moving higher. And underlying the surface, I think a lot more Canadians are starting to recognize, well, wait a second, food prices are higher not because of interest rate levels, but because of conflicts in Eastern Europe and weather patterns in Latin America. How do interest rate policies make it so that, we change geopolitics or semiconductor prices that are happening abroad? So underlying these numbers, we can celebrate, and economists will, that we are heading back towards 2%. But there is this underlying theme that maybe this concept of 2% inflation, well, it means less than it used to, and perhaps we're putting too much emphasis on that being the line item for success.
Right. There's almost been a bit of a decoupling, right? There's the inflation issue and then there's the affordability issue. And the things you spend most of your money on, like food. I mean, it's not 10% this month, it's 9.7% food inflation, which is oddly good news given the past year. But like you outline some of the reasons on why it is so stubbornly high, because of the conflict, because of weather patterns. What's the sense on when food starts decelerating back down to a more normal rate?
Well, there are leading indicators that tell us, well, food prices should start to normalize. And remember, this isn't just a Canadian issue. This is happening globally. And it's not because you and I are eating too much food. Well, maybe we are, but that's not why food prices are too high. It's not because demand is just too high for grocery right now. No, it's because we have supply shortages that persist globally. So food prices should be coming down in year over year terms. But again, these are not going to say that we're actually going to see food price deflation, which is negative prices. Right. This is just saying that things are going to be going up, but at a slower pace. I don't think that's enough for most Canadians who are still feeling the weight of this affordability issues. And not just in food, David, but also in energy prices and, of course, in housing as well.
Right, because even if it stops going up by the large amounts, those increases are baked into the base price. That's there every week when you go to the grocery store. And you mentioned housing because while food prices, monetary policy can't bring that down. Monetary policy is driving up rents and mortgage payments. And the central bank is hinting really that rates are going to hold there for quite some time, probably through the rest of this year. So what do you think that means for Canadians and their ability to meet this affordability challenge that's plaguing the country?
Well, it's going to be challenging, and it's actually challenging in part by design. That's how monetary policy works. It says, well, there's too much demand for too few goods. We can't raise the supply of issues that are, globally occurring. So let's just bring down Canadian demand. Let's make it more difficult for Canadians. And the monetary policy approach is, well, it'll be short-term pain for longer-term gain. But it puts the central bank in a really difficult position, because one of the things they want to avoid is telling us, well, actually, it will get easier ahead. They don't want people
Yeah.
front running, particularly into the housing market. That expectations channel is really important, and it's actually one of the key components of monetary policy. So we're going to continue to hear a central bank in Canada and globally telling us, no, we're not going to be cutting prices. That's a critical component of their existing policy. Of course, they will eventually cut interest rates, probably by the end of this year, maybe into 2024. We're not likely to see more rate hikes again, but the threat of rate hikes is sometimes as powerful as rate hikes themselves.
Right, that was going to be my next question. I mean, their forward guidance, such as it is almost like we're going to hold steady for the next little while, and then the market is kind of banking on a rate cut. But you think the idea of a rate hike is less likely, even if we look at, like, say, the Federal Reserve in the United States maybe continuing to go up? You think Canada holds and then eventually reduces?
Probably. That's a base case. Of course, there can always be one or two rate hikes or cuts that are outside of the base case forecast. But the real story is that, yes, Canada has slowed. They're probably on pause. And that's because rate hikes are more powerful in Canada than they are in the United States. Our economy much more sensitive to rate hikes than the US equivalent. And the US also has the ability to move markets and financial conditions, as economists call them. We can't do that as much in Canada. I'm a proud Canadian, but our central bank is not as powerful as its American counterpart. So even another rate hike or two from the US, which is expected largely, is not going to mean that the Bank of Canada has to follow suit necessarily. Like, the Bank of Canada is probably going to continue to say, we're on pause. They're going to hold that line as long as possible. And today's inflation data allows them to do that.
Okay, so the risk that could be there for people with variable mortgages, as bad as it's been, you think it'll probably hold steady for a little while and maybe get better by the end of the year. I just wonder, what are you watching for next? Like, when do you think Canadians will start to feel the benefits of this decelerating inflation and start to notice any kind of a difference in sort of the cost crunch that they've been facing? Is there a horizon where you can see that really filtering down to the average Canadian family that's had a hard time these past year or so?
Well, a lot of this depends on what type of Canadian family you are, and what you're focused on. If you're still, you have particularly for lower income Canadians, they spend a larger share on food prices. That's not going away tomorrow or the next day. And we have to be really honest about the idea that even if inflation year over year is coming down, it doesn't unwind that stress that exists in the system. Now, if you're out there looking for lawn furniture or fitness equipment or goods, things that economists say drop on your foot that hurts, well, those are getting less expensive, and you may even see real deflation in those numbers. And that's because, you can only buy so many rowing machines and treadmill machines. Everyone bought those during COVID. That demand is going to calm down. But when it comes to some of these really key components to what drives family finances in Canada, those are likely to stay elevated through to this year end. The hope is that we get some relief from the Bank of Canada later this year and into 2024, where they say, you know what, the cost of borrowing, it doesn't need to be as high as it is right now. Our concerns about inflation rising, reaccelerating, those are mitigated. So that's where the real relief is going to come from.
Okay, Frances Donald, always appreciate the insight. Thanks for joining us.
Thanks for having me.